Hey everyone, Amazon stock is up a whopping 75.45% so far in 2023. Now, I have had Amazon stock rated as a buy for most of the year, and my question here that I'm going to answer in this video is Amazon stock a buy for 2024 after rising so much already in 2023? So, to answer that question, I'm going to look at a few statistics, a few financial metrics, and I'm going to look at Amazon's valuation after rising so much in price to determine if I think investors should buy this stock ahead of 2024. So let's get right into that.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So one of the reasons that Amazon stock is up so much in 2023 is because of its phenomenal performance, mostly on the cost side. Mostly on the cost side. While revenue has increased for Amazon, the growth in profitability has come from controlling costs. Remember, Amazon invested aggressively during the earlier stages of the pandemic to prepare for that unprecedented surge in spending it experienced when people were sent home and were shopping from home more than ever before. Now they've controlled costs, they've grown into that investment, and it's starting to show. Let me show you what I mean. So net sales increased by 13% in their most recent quarter to 143 billion, but operating income increased to 11.2 billion in the third quarter compared to 2.5 billion in the third quarter of 2022. So while revenue increased by just 13%, operating profitability increased by nearly 5x. So you could see that leverage that the company is demonstrating here in terms of profitability. The company showed similar results when you look at cash flow. Operating cash flow increased by 81% in the most recent trailing 12 months to 71.7 billion. That was compared to 39.7 billion for the trailing 12 months that ended September 30th, 2022. Free cash flow improved to an inflow of 21 billion compared to an outflow of 19.7 billion. So Amazon is turning the small sales growth of just 10% or just above 10% into phenomenal growth in operating profitability and cash flow. One of the reasons they've been able to do this, management said, is because they switched from a national fulfillment model to a regional fulfillment network with 8 regions, and it's allowed them to get closer to customers, reducing the length of shipping, and that's reduced the cost. It's also allowed them to increase delivery speed, and that's led to a improvement in customer satisfaction while also reducing costs because the cost per order has fallen because of the decrease in shipping costs. So Amazon has done an excellent job, and management said we're not even close to the end of finding cost efficiencies. So they've got more and more areas where they feel that they can reduce costs, even though they've already done so much to bring costs in line. And for one thing, I think the new CEO has done an incredible job here since taking over for Jeff Bezos. Also, looking beyond just cost, looking at revenue, let me show you the prospects. So, according to Statista, retail e-commerce sales compound annual growth rate from 2023 to 2027 is expected to grow by 11.16% globally, 11.22% specifically in the United States, with most regions around the world expected to experience double-digit compound annual growth in the next 4 years. And I would say that this is understandable considering the added convenience e-commerce offers over shopping in person. Now, for a brief moment, people were spending a lot more money on away from home experiences, including travel and restaurants and concerts and theme parks and things like that. I would say that will continue for the better part of 2024, but I think starting 2025 we'll start to see a more normalized consumer spending pattern, and that's going to benefit companies like Amazon, who depend on people spending more money on goods than they do on services, or not more money on goods, a more normalized level of spending between goods and services, which right now is a little bit out of balance in favor of services, given how people are unleashing the pent-up demand to spend money on services after 2 or 3 years where they were not spending as much money as they would like to on services. People were delaying vacations, delaying vacation travel, delaying going out to restaurants, or reducing the number of times they went out to restaurants, not going to theme parks because they were afraid of contracting the COVID-19 disease while being out around so many people. And now they're making up for lost time, going out more often. That's likely to continue for the better part of 2024 because there's still room to go in that trend. We're still not spending overall as a worldwide population. They're not spending enough. They're not spending as much money on travel as they did in 2019. So it still hasn't recovered to 2019 levels, despite the fact that the amount of spending is growing year over year significantly. Nevertheless, e-commerce spending over this next few years expected to jump by 11.16%, and you already saw how good Amazon is at turning just double-digit revenue growth into phenomenal profit growth. Longer term, if I go back a decade, Amazon was doing an excellent job doing just what we talked about in the most recent quarter, using revenue growth to leverage their infrastructure and grow profitability and cash flow. Look at Amazon's cash flow from operations to sales in a trailing 12-month period going back a decade. If you ignored this part here for a second, I'm going to get to that, but look at how Amazon grew exponentially here, increasing their cash flow from operations to above 15, close to 20%, before coming down significantly because of that factor I mentioned earlier. Amazon invested aggressively in their network to make sure they can deliver the items that people wanted when we were locked down at home. They said, you know what, let's invest. Let's make sure people get what they need. And if it costs us a little too much, we'll make up for it. We'll grow into it. And that's what's happening now with the rebound back upward to 12.93%. But more importantly, Amazon has demonstrated that they can grow while increasing the cash flow and profitability. They've demonstrated that they can deliver economies in scale, which is a skill that not very many growth companies can achieve, especially one that's generating revenue above $500 billion. Amazon has done the same thing with operating profitability as they were doing with cash flow from operations. You can see here in the purple, Amazon's operating profit margin over the trailing 12 months over the last decade was growing just the same way CFO was, cash flow from operations was, before coming down and then rebounding from that factor I discussed earlier. And just to put it into context, I have here Walmart in the orange and Costco in the blue. And you could see that Amazon is outperforming both Walmart and Costco. And at its peak, it was outperforming them by a considerable margin. And now it's recovered back up above them as well at a 4.76 operating margin compared to 4% for Walmart and 3.35% for Costco. Amazon, I wouldn't be surprised if it reaches back above 6% sometime in late 2024 or mid 2025, increasing its operating profitability. And finally, Amazon's forward price to earnings ratio at 42.65 is at the highest point all year. You can see it started the year at a much lower valuation. That was before the company demonstrated that turnaround in cash flow and operating profitability. And now the stock price has reflected that boom in performance for Amazon. So to answer the question, do I think Amazon stock is a buy heading into 2024? I would say the answer is yes. Amazon stock is a buy heading into 2024, in my opinion. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.